Welcome to the Global View on this Wednesday. Let's take a look at what's going on at a macro level. The US Federal Reserve has begun its two-day policy meeting, with those policymakers expected to keep interest rates on hold, while markets are pricing in an increased risk that rates will stay higher for longer. Fed funds futures are pricing in a 29% chance of a Fed hike in November and a 40% probability of an increase by December. Well, US 5 and 10-year Treasury yields reached 16-year highs, with the 10-year touching 4.36%, the 2-year at 5.1%. Meanwhile, US home building plunged more than 11% last month to a more than 3-year low as increased mortgage rates weigh on demand. And across the border, Canada's annual inflation rate in August jumped to 4% from 3.3% the previous month, driven by rising fuel prices, prompting speculation that the central bank there may be forced to raise interest rates again. Well, the Canadian dollar rose around 1/3% on that inflation data. The US dollar index also edging higher. The Aussie dollar trading at 64.6 US cents. That's after the RBA yesterday revealed its minutes from its September meeting, leaving the door open for more rate hikes locally. Well, for more on the impacts of inflation on the US economy, let's catch up with Chad Padowitz. He's the Chief Investment Officer at Talaria. Chad, very good to catch up with you again. Thanks for joining us.
Good morning.
So just, of course, running through what those expectations are for the Fed, with pretty much priced in, there will be no move. I guess the key is going to be those dot plots, isn't it?
Yeah, well, look, we don't get involved as a business forecasting short-term interest rates, but I think what is evident is inflation is quite sticky, as the idea that it was transitory is obviously being quite debunked. And as you mentioned earlier, the 10-year yield is is at 16-year highs. So the market is expecting inflation to be sticky and interest rates to stay high. Whether they rise again or how many more rises, I don't have a strong view on that, other than I think we're getting closer to the end, or pretty close to the end. But I think the biggest risk is potentially any expectation that they can drop quickly from here is historically would be quite rare from a historical context. Interest rates generally, once they're up, stay up quite a while because it does take a long time to tame inflation.
So, Chad, what effect is that inflation having, particularly with household income in the States?
Yeah, so inflation is a tax on consumers and particularly lower income consumers. So that's one of the reasons, probably one of the main reasons why inflation is seen to be a bad thing. And what we have seen, although wage growth has been going up and unemployment is quite low, the actual real consumer spending is actually going into reverse. In fact, it's actually down for the first time in a while. It's actually down in the last year a couple of percent. So, inflation is having an impact. And, we've had the wage growth already, which I think until inflation starts coming down, that's going to particularly continue to hurt consumers, to hurt consumer spending, to hurt the economy. And, and ultimately the market will be impacted by that.
Meanwhile, and as I referenced, the global oil price continues to rise. So some forecasts are going to hit $100 a barrel. Of course, this comes as we saw those cuts from Saudi Arabia and Russia extended to the end of the year. So how inflationary is that likely to be, do you think, Chad?
Yeah, well, obviously energy fuels the economy, and oil is, despite, many attempts and ongoing attempts to obviously decarbonize the global economy, we're still predominantly a fossil fuel driven, oil driven industry. And, because of that, oil prices going up now on the back of already high inflation and the impact it's having on consumers as discussed, I think it's an increased challenge. There's nothing really good about that. So it's going to definitely make things tougher.
All right. So given where inflation is tracking at the moment, how is that influencing your investment decisions, particularly if you have the assumption perhaps that the economy is heading towards a recession?
Yeah, so look, we definitely think the lagged impacts of interest rates have not yet been felt on the economy, and that will happen over the course of the next several quarters, which will impact the equity market, alongside that. Because of that dynamic of a weaker economy, weaker earnings, weaker valuations, what we've done, we're applying a couple of things in our investment process. One, we price income as a component of return. So you want to generate the greatest portion of your total return out of income if you can, because it's less susceptible to capital movements. Secondly, lower financial leverage businesses. So companies, we're not really invested in any of the banks. We're not actually invested in energy companies in a great amount. We think companies like healthcare, global pharmaceutical companies do very well because their demand is not really impacted by changes in the economy, changes in interest rates or inflation. Insurance does quite well. Regionally, countries like Japan, I think, is disproportionately a more attractive opportunity, given the backdrop we have at the moment. So those are sort of the things we're doing.
So you mentioned healthcare, in particular pharmaceutical companies. Well, let's go there because I know you do have your eye on one particular stock, that being Gilead Sciences, the biopharmaceutical company that's based in California there. Why are you liking this one?
Yeah, so Gilead is, it's not one of the mega caps, but it's still very large. It's about a $94 billion market cap company, but they make about $9 billion a year in free cash flow with no patent expiries till, well into the next decade. So, the company, from a valuation point of view, already pays for itself from its earnings without any of the R&D, which they're spending about $5.5 billion a year on R&D. So you have a significant amount of current earnings at a valuation of about 10 to 11 times. And you've got a very big R&D machine. And this is a company that's effectively not so much hasn't cured AIDS, but it's turned it from a terminal disease into a chronic disease. And it's cured Hep C. So the actual science and the quality of their R&D, you can see is quite substantial. So because you have valuation, you have chronic diseases that they treat. So people aren't going to stop taking that, even if incomes drop a bit or inflation and interest rates, as I mentioned, and you have a very good R&D engine behind you as well. So the combination of defensiveness, valuation, and R&D opportunity is, I think, quite a unique mix that's particularly of interest at this current, more challenged environment.
And you're pointing out that shareholders of the company are benefiting because of its high levels of free cash flow, likely to come back to them in the forms of dividends and buybacks.
Yeah, about 50% of the earnings they give back to shareholders, dividends well over 4%, and buybacks as well. So, it's not just, they're not empire building here. They are a commercial enterprise that they share some of that success with shareholders along the way. So it does give, from an income perspective, which I mentioned a bit earlier, they certainly do contribute in that regard as well.
So Chad, beyond Gilead, are you looking elsewhere, particularly at those biopharmaceutical companies?
No, we're more in the global pharmaceutical. We're not in biotech as such. It's more companies like Sanofi, Gilead I mentioned, Novartis, Roche, Johnson & Johnson, large cap, long patent life pharmaceutical companies where the R&D that is being spent, we're not paying much on the dollar for that. So any benefit we get from that would be in addition to the cash flow that comes from the company, which underpins the current valuations.
All right, so earlier there you said, so you're avoiding financials, you're avoiding energy, you do have a focus there on healthcare. Any other sectors that you're finding attractive right now, and sort of regional too, as to where you're looking?
Yeah, so look, we are just to be clear, we're a bottom up, so we go where the value is. Yeah. We don't from a top down perspective. In terms of bottom up opportunities, we're not seeing much opportunities generally across in the US market. Where we are seeing regionally is in Japan. So we have around 15% in Japan. We see that as a market that is improving from, not a great level, but it's far improving its governance, its, shareholder hierarchy in, what's important to the company management. The balance sheets are in exceptional state there, and the valuations are very attractive. And the economy, it hasn't really been growing much, obviously, for the last, 20 odd years, but it's certainly it's suddenly got a bit of inflation into it, and inflation at a from a zero level to a slightly higher level gives a bit of pricing power. So we quite like Japan. Sector-wise, other than healthcare, the vast majority of our exposures are very much just stock-specific and company-specific, and I wouldn't really say they've got a broad theme attached to that.
Do you have your eye on emerging markets at all?
We have, so we do invest in some emerging market companies. We have a company, FEMSA, which is a Mexican conglomerate that's very big in convenience stores, much like 7-Eleven, but they've got well over 7,000 of those in Mexico and surrounding regions. They're also, they used to be one of the largest shareholders in Heineken, which they sold. So they're simplifying their business, and it's a very good, well-run Mexican company. We've also got shares in Ambev, which is a Brazilian-based, it's a beer company. Also very well run. So we have, it's not a big portion of our investment portfolio because we are invest only in developed market listed companies. But if they do have an ADR listed, we will look at them. And we do have as I mentioned, a couple of emerging market stocks.
Chad, great to get a view of your strategy there at Talaria Capital. Thanks for joining us.
Welcome. Thank you. Bye bye.
All right, that's the global view on this Wednesday. Just before we go, let's check where we're likely to be going. As you can see, SPI futures off just over 0.1%. We have, it's been negative since the beginning of the week, hasn't it? So we'll see where that tracks from the opening, but certainly we're strong on global markets overnight. Fairly flat, a tad negative. Obviously, that's ahead of some key central bank meetings, the Fed among them. And also we do get the Bank of England and Bank of Japan later this week as well. Stay with us, the Open's just around the corner.